Okay, thank you very much. So, obviously, a lot's been happening this year, and really, we could probably retitle this topic um, something closer to the day coronavirus nearly broke the financial markets, because that's basically what we're going to talk about: is the stresses in all the different financial markets and how they dealt with it, and what the sort of drivers were of the markets during especially the March-April period. So I think the right place to start is with the underlying economy and looking at the actual drivers of what the market was reacting to. And I think at a really high level, these two charts basically highlight what was happening. So as coronavirus spread through Europe and came into America, into the USA, you could see the governments very quickly in the US shut down businesses. So the number of businesses that went from open to closed went from basically 100% open to 50% closed in the space of about a week and a half, 2 weeks. That 17th of March to 23rd of March period, you'll keep seeing coming up in a lot of the data that we're going to look at today. Even the hourly hours worked for employees did the exact same thing. And in that same window of 2 weeks, you could see the hourly working came down 60, sometimes 70%. So a really dramatic shift in terms of employment, in terms of income, a massive shock to the market. And of course, with that was the expectation that we were going to see a huge spike in unemployment back to potentially Great Depression levels, well above other recession levels, and we did. And so as the market was forecasting that, the uncertainty and the economic risks were very high. We also were expecting that GDP growth would be dramatically affected, and it was. So if we look back on this chart to 1947, we had never seen a quarter of GDP shrinkage like we saw in Q2 this year. And so the market was trying to work out just how bad this was going to be. It turned out to be really bad. And so the market was doing its job at trying to price in what that meant. So when we look at sort of what actually happened in the market, what we started to see, at least a week or two after, was investors everywhere were in a dash for cash. So you could see the data coming through in terms of what corporates were doing, knowing that their businesses were being shut down, looking at their revenues and their cash flows. A lot of corporates went to banks and redrew loans or created new loans and drew down some funds. So the banks themselves suddenly were issuing cash out to corporates so that the corporates had a bit more of a buffer. Other corporates were issuing debt into the bond market. And all of that stressed the banking system, which we'll talk about. You saw some huge spikes in things like US corporate yields from relatively low levels to 4.5% and back down in the space of that week and a half, 2 weeks. Just a massive shock to funding markets in the US. And so what we were hearing pretty quickly was a lot of the bond market basically had completely frozen up. If you look at some of the quotes on the left-hand side of this screen, although the bond markets are different than stock markets in America because there is no quote, there's no tape, there's no bids and offers and spreads that you can see live that everybody can trade at. It was basically anecdotally true that the market had completely frozen up. There was a lot of people reporting that there was no banks bidding in the market. And so liquidity had become very one-sided. People wanted to sell to raise cash, and the banks themselves had got so stretched on their balance sheets and their risk themselves that they didn't want to bid. Market makers couldn't bid. And so the market for bonds really did deteriorate pretty quickly. And that was true until you saw some pretty dramatic rescue plans. We saw in the news that a lot of the banks that have prime brokerage businesses were pumping money back into the money market funds. You saw the G7 leaders say that they would do whatever is necessary. You saw the Fed increase its repo options by a phenomenal $1.5 trillion and issue $2.3 trillion in new loans. It was just phenomenal, the extent of the rescues that came and the size of the numbers that were being talked about. And so if we look at what happened in the bond market, you can definitely see some signs of stress. So this left-hand chart is looking at how treasury bond yields performed versus the equity markets. And you can see as the coronavirus fears increased, the yields on the bonds fell down, which is the blue line here, because it was pretty clear that the government was going to have to rescue it was going to have to rescue the system, and it was going to be a lower interest rate environment in the future. Along with that, obviously the equity market, which is the orange, was falling because it was pretty clear that earnings were also going to come down. But then when you hit this March 9 period, you see a snapback in bond yields. And so obviously if bond yields are going up, the prices of bonds are going down at the exact same time that the price of equities are going down. So that natural hedge and the inverse correlation that a lot of hedge funds and a lot of diversification strategies rely on completely broke down. In this window, we saw gold being sold when everyone was panicking. So it wasn't a risk off, risk on period. It was a total cash raising period. And you can just see the extent of that from the snapback in bond yields. We can look at some other places to see the stresses on the system. So the right-hand chart here is looking at longer-term treasuries, which have more maturity on them in terms of they were issued longer ago, the off-the-run bonds, compared to the most recent issue or the more liquid bonds. And you can see in that March 12 period, even the most liquid treasury bonds in the US saw a spike in spreads from less than 5 to almost 15, so quadrupling in spreads. But the less liquid treasury was from the same spread initially increased to almost 0.5%. So you can see off the run, the less liquid side of the market that needed more inventorying really saw dramatic increases in costs to trade. We can also see it in the corporate side of the market. So the purple line here is showing the overnight rates for corporate debt, and the orange line is showing a 1 week borrowing. And so you can see this dislocation between very short-term borrowing and longer-term borrowing, and not even that longer term, but borrowing increased dramatically, even though the Fed was pushing rates down. So a huge dislocation on the corporate side. And then finally, on this chart on the right, you can see the bank's short-term funding costs increased from about 10 basis points to 80 basis points at that March 13 date, and has then stayed pretty elevated coming out of the sort of March-April period. So just huge stresses on the system. And what we started to see in the press was that hedge funds were being asked for redemption. So another reason to be raising cash, hundreds of billions of dollars. Also, hedge funds were wrong-footed by the changes in correlation, so they had big losses. And a lot of the funds that were trying to do market making were actually basically their T+2 settlement positions were soaking up so much capital that they were asking if they could have relief from some of their capital adequacy rules. You saw some massive hedge funds like Millennium announce that they'd shut down whole trading pods. So obviously that results in a pretty significant reduction in buying and selling, like two-sided hedge positions across multiple asset classes, huge needs for liquidity on both sides of the market. So you can start to see the stresses building in the system. And what we found with some later data is a lot of the hedge funds actually liquidated both sides of their balance sheets by around about 3/4 of their exposure. So hedge funds just took risk off the table, unwinding a lot of the positions that they'd had on in the past. Huge amount of liquidity demand from hedge funds just trying to get out of the positions they'd had on before. And so obviously all of that trickled down into stock market stresses. And so that's really where it got interesting for me, working at the Nasdaq in a stock market. And we know now that we saw the fastest bear market in history. From peak to down 20-30% was much quicker than a lot of the other recession-driven market sell-offs. But we also have now seen on the right-hand chart one of the strongest recoveries. So far we're running well ahead of some of the recoveries out of other bear markets, and a lot of that would support the V-shaped recovery that people are saying we expected to have from something like COVID, where we shut down the economy aggressively, but then allowed it to reopen pretty quickly as well, with a lot of stimulus and a lot of short-term unemployment. So what happened to the markets during that period is where it gets really interesting. What this chart is showing is the height of the bars is the shares that trade in the US stock market every day. And so we went from trading around about 7 billion shares a day to pretty quickly trading almost 3 times that level. In fact, this record for the coronavirus period on the 28th of February was before all of the businesses shut down. This was because The market was watching what was happening in China. It was watching what was happening in Italy, and it knew that things were getting bad. It's actually not an all-time record. There was slightly more shares traded on one of the days in the credit crisis, but it's clearly a massive liquidity event. It was nearly $1 trillion worth of equity trading on that day, which was a record. We then saw a bunch of other spikes. The colors of these bars indicate the daily return. So a very red bar is a big down day. A very green bar is a big up day. And on this day here, this March 13 day, you can see another massive volume day, a big downdraft in terms of the stock market. And that triggered a lot of problems downstream in other countries in the world. Luckily on a Friday, because it gave them the weekend to sort out settlements and bookings and risk limits. But you can see, even after we've come out of that March-April period, we've had elevated volumes until quite recently. We've actually been trading pretty consistently above 11 billion shares a day. So about half a 50% increase in the pre-COVID levels, consistently out past there. And so with the stresses on the system, a huge amount of trades that we weren't used to seeing, the market generally performed pretty well. There were a couple of reports in different countries of just the huge trade count explosion, putting at risk some of the overnight processes, so downstream settlement, back office processes. ASIC, which runs or supervises the Australian exchange, actually requested firms reduce their number of trades by 25%. And that was enough, and it was actually done pretty successfully, just to make sure that overnight, a lot of the back-end processes, settlements and netting could be done successfully without causing systemic risk. If we look at what happened in the volatility market in the US, you can see volatility, which is the right-hand axis on the left-hand chart, went from well below 20, and it spiked up. Realized volatility spiked up to about 150 in the space of 2 weeks, and then came down but stayed quite elevated. To put that 150 in perspective, if you draw a line across all of the last almost 100 years of trading and look at realized volatility, there's only a couple of times where we have breached that level. Not in the credit crisis, not in the tech bubble, not in any of the sort of 50s and 60s crashes, not even in World War II. It had to be a depression or Black Monday, which is the 1987 crash, to leave realized volatility in a 5-day basis higher than that level. So this was a huge amount of fear in the market. It sort of puts it in perspective. The other thing that was interesting, if you look at these yellow dots, that's lit market share. So in America, we have quite a lot of off-exchange trading. And as soon as the volatility spiked, you actually saw the off-exchange trading volumes decreased significantly. And the lit markets were the only place where the liquidity was able to be hit. And so the market share of the lit exchanges increased pretty significantly. If we look at some other market quality metrics, what you can see here is the average spread. So the bid-ask spread on the average stocks increased 4 to 5 times in that period. So we went from having, for S&P 500 stocks, a spread less than 4 basis points to 16 to 20 basis points on average, a big widening of spreads. And at the same time, you can see the green line, or the green area, shows that the depth that was actually on that quote, so the amount of value that was offered and bid, decreased around threefold as well. So the market widened and it got thinner while all of this stress was going on, which is expected, but it made it obviously much harder for those hedge funds with liquidity requirements to meet those requirements without having market impact and making things arguably worse. And so not surprisingly, what we started to see over time was a couple of hedge funds really did struggle. We saw a couple of hedge funds actually shut down their doors thanks to margin calls and just thanks to the losses induced by the breakdowns in correlations. We saw the oil market, obviously in the US, one of the futures contracts expired at a negative value because nobody wanted to take physical delivery of the oil future. And so the price of oil for the delivery actually went negative, and that created a huge amount of losses in some of the accounts that Interactive held. So there was a few losses that people had to wear, and there was a few hedge funds that couldn't meet margin calls and actually had to shut their doors. And so with that, you can start to see, so what happened in the market was pretty dramatic. It had some flow-on effects. Running the Nasdaq market, what was interesting to us was we actually saw an increase in message traffic of about fourfold. So before we saw all of the risk hit the market, we were running at about 15 to 17 billion messages a day across all of our stock and options markets. When we hit that sort of late February, March period, we saw a spike up to almost 70 billion messages a day. And that then subsided, but it stayed elevated at around double the pre-COVID levels. So message traffic, the amount of bids and offers and cancellations and fills in the market, it's not just the trade count, it's not just the volume and value trading that's increased. The message traffic has increased significantly as well, which is obviously a tech challenge, just to make sure that you've got big enough hard drives and fast enough computers and enough spare capacity to deal with the surges that come from all of the new news that's coming into the market. But it wasn't just stocks or stock exchanges that saw a big increase in trading activity. In the US, we actually saw a huge increase in retail trading as well. And so you might have read about this. It's kind of interesting because it's a confluence of two things happening at once. If you look at the left-hand chart, you can see all of the big retail broker dealers introduced zero commissions back at the end of Q3 last year. And they started to see that those zero commissions were attracting retail trading. And you can see they all saw an uptick in business when trading was free. But what was interesting is this COVID period in the red square is really where you saw the explosion in trading. And there's if you look now at where the trading levels are, you've got over 10 million trades per day across this complex of retail brokers. So that's 10 million trades coming through their systems when they used to have numbers closer to 3 million trades a day. If we convert that to their percentage of market liquidity, obviously everybody was trading more, but it looks like retail increased from around about 10% of the market 10 years ago to 15% of the market more recently to as much as 20% of the market, sometimes more on busy days. During the 2020 period. And so to put that back into sort of dollar terms, it looks like it's around $100 billion a day of retail buying or selling. So just a huge amount of liquidity coming through retail broker dealers' pipes as well. And on the retail side, and potentially across the whole market, it wasn't just stocks that saw an increase in trading and activity. If we look at the options markets in the US, you can see on the left-hand chart, options trading this year is at another significant increase, about 30% higher than the last couple of years, almost double the sort of level that we'd hit in the post-credit crisis period. So a huge increase in options trading. What's interesting is looking at how that's evolved throughout this period, through the COVID period. So if we look at index and ETF puts and calls and single stock puts and calls, you can see in the red square, when we had that March spike in volatility, a lot of people were buying puts on the index, so puts on the market, to a lesser degree calls on the market as well, and they reduced their exposure into single stock options at the same time. What we've seen recently is really interesting. We've actually seen an increase in single stock options and a pretty muted increase in index and ETF options. And especially on the single stock option side, we've seen a lot of people what look like buying calls. So even though the market is back pretty close to all-time highs, what this indicates is that people are actually buying upside risk in the single stocks. When you look at the trading activity, a lot of this tends to be in the tech stocks, which have obviously been in a great position to benefit from coronavirus and work from home, the online delivery, just some of the sectors that have benefited from Zoom that we're using right now, have really benefited and have more call exposure on their upside at the moment, even though they're at relatively high prices. And so with all of those extra stresses on the retail system, we did see some things break. There was a bunch of different reports throughout the period that showed that some of the systems actually seized up and couldn't deal with the volumes. So there are obviously operational risks that were created by the amount of volume that has happened in the last 6 to 8 months. So let's focus on the US stock market a little bit, because the US stock market has got some guardrails in place that sort of will try to protect it from big sell-offs and sort of ugly days like we saw in 1987. And so this headline here, the worst day since 2008, isn't actually as true as it looks, and it's definitely not the worst day that we ever had. because that day was in 1987, where for no really good reason at all, the stock market sold off over 20% in one day. And I guess the point of talking about this is where we started to change the market structure. When people analyze what caused the 1987 crash, it was a bit of a feedback loop. People blame what's called portfolio trading, but back then portfolio trading was as the market went down, you generated sell orders to synthetically create a hedge, like an option delta. And so those portfolio orders, those automatically triggered orders, overwhelmed the system, created a sort of vicious cycle or a feedback loop of selling that the market just couldn't keep up with. And so after that, things like market-wide circuit breakers were invented, where we would pause the market at a level, let everybody reset their thoughts, and potentially, hopefully, bring in some buyers at lower levels. But I think what's more interesting to talk about is two events that have happened in the last 10 odd years, just a little over 10 years. And the reason for that is because these two events happened in an electronic market when feedback loops could create themselves much faster and have an impact in a much shorter period of time. And because of both of these events, the way that the US market-wide circuit breakers work did change, and we're going to see that they worked pretty well in general. So the first thing we want to talk about quickly is the flash crash of 2010. And what happened on that day was at around about 2:30 in the afternoon, the market started to sell off, and it created a feedback loop where bids were getting hit, and people turned around and sold on top of that because their positions got too large, which created extra selling. And within the space of about 8 minutes, the market had sold off almost 10%. It did bounce, and it closed the end of the day not down that much, and so it doesn't show up when you're looking at daily returns as a really bad day. But this day made people think about whether the 10% market-wide circuit breaker level that we had in place was the right level. And so that circuit breaker was reset to 7%, which brings me to talking about August 24, 2015. So on this day, this was a Monday after the Chinese stock market, which had been in a bubble, had sold off a lot. The Chinese manufacturing data was weak. And so people had been expecting the market to weaken for a long time, and it did. We had sold off on Friday on the back of some of our own production numbers, and we all woke up in the morning to see a lot of sell orders in the system. What's interesting about this day, though, is the actual futures, the actual market index, the SPX index here in dark blue, never sold off over 7%. So we didn't actually trigger a market-wide circuit breaker. What it turned out was because the market was pre-open, sold off so much, a lot of market makers and liquidity programs actually held up single stocks. And so when they held up the single stocks, those prices didn't update from the night before. And so the S&P, which was responsible for the index, couldn't calculate a completely live price for the underlying index because a lot of the prices in the index were stale. They hadn't opened yet. And so if you look at the futures price, it went down more than 7%, which indicates that we should have had a market-wide circuit breaker. You could estimate the live index price based on the trading away from the primary that we saw in all of those tickers that were not open. So the off-exchange trading and the trading in other venues. And we clearly should have had a market-wide circuit breaker that day, but because of the way the index was calculated, we didn't. And so after that, the S&P changed the way that they calculate the index, and they included all live prices off the SIP, which is our tape. And so that it actually had a major impact, as we'll see, in the market-wide circuit breakers this year. So when we look at what was happening this year, we had 4 market-wide circuit breakers at this 7% level. 3 of them happened within literally a few minutes of the market opening, and we could see that that was going to be the case. You looked at pre-market futures, they stopped limit down 5%. We could look at the S&P 500 ETFs, which were trading down 7 to 8% pre-open. And so it was pretty obvious that we were going to hit a market-wide circuit breaker, and we did. And so what you see is the market paused for 15 minutes, let the bids and offers replenish in the system, and generally the market reopened at roughly the same levels, that 7% down that we'd seen the market stop at. If you look sort of out an hour or two, this is in minutes on the bottom axis, pretty much every market had come back to being above the circuit breaker level during that period. The one market that sold off aggressively afterwards obviously ended up down a lot too. That was on the 16th, which was the day that caused a lot of the volatility globally. It's even interesting to look at what happened to the stocks before the circuit breaker. So this chart on the right is grouping all of the stocks that were paused by the market-wide circuit breaker based on what their return was before the circuit breaker. And there were some stocks in this green bucket that actually increased before the circuit breaker hit. There was some stocks that decreased more than 10%, which is the purple line here, before the circuit breaker. And what's interesting is each of these buckets actually held pretty consistently once we reopened, and even as much as 10 minutes later. So the market pretty quickly got each stock to the level that it was actually going to reopen at and trade at for the next few minutes after the reopen. So arguably what the market-wide circuit breaker did was stop that feedback loop, which is what it's designed to do. There's a couple of other guardrails that we have in the US. One is the limit up and limit down rules, which apply to single stocks. And so what they do is they basically provide guardrails around the current price. So a single stock can't gap down or gap up too quickly. If that happens, you stop people from, if it gaps down, you stop people from selling it at levels below a certain point. And there's different ranges for different liquidity of stock. But what we actually found, if you look at the count of limit up, limit down, so single stock triggers, they had this hump in March, right around all those dates we've been talking about. The yellow days here are the days we had market-wide circuit breakers. And what's interesting about the market-wide circuit breaker days is obviously those were days where the stock market sold off aggressively. And what we actually found is when we reopened, if you look at the time frame on this insert chart, the immediate reopening actually had more orange bars, which is limit up, than it had blue bars, which is limit back down. So when we reopened the whole market, a lot of stocks actually gapped back up, which is what you wanted to happen. You wanted to see liquidity come back into the system, support the stocks, recover from an oversold condition. And we did see that, especially in these market-wide circuit breaker days, consistently. But you can also see that the limit up, limit down was in place for a lot of stocks during this period of volatility. There's one more guardrail that we have in the US market, and that is short selling restrictions. So the way that the short selling rules work in the US, it works all the time. When a stock sells off 10%, what you have to do if you want to sell it is not only have it pre-borrowed and financed, but you can't then hit the bid. You can't force the bid price down to a lower level. You have to basically let a buyer come into the market and hit you at an offer that's above that price. And so that stops somebody who's a short seller from forcing the market lower. And it automatically happens. It happens every single day. As you can see from this chart, the periods in February, there's a bunch of short selling restriction stocks. The yellow bars again are the market-wide circuit breaker days. And just for perspective, the US market has just over 8,000 stocks. So this period in March where the volatility was high, we had around half to 3/4 of our stocks with short selling restrictions, just as a natural course of business. I highlight that because in Europe, a lot of the countries put in emergency provisions, which were difficult for brokers to code to. It created a lot of problems for market makers who weren't ready for the rule applications that were built into the new short selling rules at a late last minute, in the middle of all this volatility, in the middle of wider spreads and less liquidity. And so we had a lot of stocks that were harder to short, but not different to short than normal. And I think that helped us in the long run. And speaking of the long run, I just want to finish with a little discussion of some of the potential lasting impacts of what we've seen in this sort of March-April period. And so some of you may remember in the middle of the sell-off, a lot of people were talking about closing the markets for a week or so. Which reminds me a little bit of how my daughter deals with scary movies. It's, if you close your eyes in the scary part and then you reopen them later, it won't be scary and everything will be okay again. And in fact, when you do research into market closures, you find that that's not the case. We actually looked at different periods in the US across the last 100 or so years on this left-hand chart. And you can see the realized volatility spikes. The red arrows are times when the market shut for an extended period of time. A lot of them had nothing to do with volatility. So the paper crisis, basically volumes had increased so much that humans couldn't process transactions. And on Wednesday, the market was shut so that we could catch up. And Hurricane Sandy was an infrastructure problem where New York was flooded and so people couldn't get to work and there was no electricity in Manhattan. So events like that were more operational. A lot of the volatility spikes, we did not shut the market. And there's good reasons for that. And thankfully, we didn't shut it again this time. When we actually looked at the events that were volatility events where markets shut, if we add in the Arab Spring, which was where the Egyptian market shut, when there was a lot of violence in Egypt and in the region, what you see is before the market shut, the markets were mostly selling off. But when they reopened on this right-hand chart, they reopened down. And almost always they reopen with more volatility over the next week or two as well. So closing your eyes with stock markets or with markets themselves doesn't actually make the pain go away. We know from all the things we've just talked about, it would have made it much more difficult for those margin calls to be funded, for the banks to raise cash, to issue to companies, to be able to pay for wages. It would have had a huge detrimental impact on the capital markets. And it might not have done anything to make volatility better. It may have even made it worse. So it's good that we didn't shut the market, but there's more reasons to say it was good. And on the left-hand chart of this slide is a couple of great ones. So during the coronavirus period, rather than shutting the market down, companies like Moderna and a lot of other biotechs were actually able to come to the stock market and raise cash to increase their research, to speed vaccine research and speed production of a vaccine. Other industries like the airline industries were able to raise billions of dollars of cash to be able to pay wages, to be able to keep people employed or avoid furloughing as many as possible. So two good things for the economy coming out of being able to raise cash. And if we look at the right-hand chart, what we've seen is actually once we came through the period of volatility in March and April, the IPO market has bounced back stronger arguably than ever. The amount of capital raised this year for listed companies has increased significantly. We've had a very active Q3 in terms of IPOs. And so we've been able to bring more capital to market and help companies become public at the same time as all of what's playing out this year has happened. And potentially, ironically, but it was good to see after all of the fear, the US regulators, both the futures regulator and the equities market regulator, realized that the stock market passed the test pretty well. We didn't really have any outages. We delivered constant liquidity. The market-wide circuit breakers did their job, and it helped the market stay liquid. It helped hedge funds get out of positions. It helped margin calls be funded. It helped companies raise capital, and it helped the economy to function, which is arguably the whole point of the stock market and the capital markets. So with that, I can stop.
Thank you so much for your presentation, Mr. Mackintosh. For the Q&A section, let's welcome Panama Stock Exchange CEO, Olga Cantillo.
Hello, hi. Phil, thank you for the insightful presentation on the effects of the pandemic on stock markets and markets in generally. It was very important to see how you highlighted the closing of stock markets during the volatility of the pandemic of COVID in the markets. And it's definitely been a challenge for stock markets around the world. We saw that a few of them were forced to close due to the pandemic, since they had or were forced to work from home and had some technical issues in regards to that, and not necessarily due to the spikes that you showed on the beginning of the pandemic. So it was very important to see that. And for us, it was also a challenge, but well prepared ahead of time to be able to provide our market with the continuity of the business. So that fortunately was not and has not been the case for Panama. It was, and you made it very evident that for us market infrastructures, we have an important role in facilitating the economic reactivation of our countries. So there we have a lot to work on along with our government. We have many questions for you, and therefore without further ado, I'd like to start the Q&A session. and I'm gonna go and look what first, because I also received some in my cell phone. And the first one that we have is, as a tech company yourselves in Nasdaq, do you believe that since the start of the pandemic, there might be a bubble inflating?
In tech stocks specifically?
I
That
would imagine so,
That
yes.
is a super interesting question. So when you look at valuations of the stock market, you you can look at the fact that we are close to all-time highs, even though earnings have actually declined sort of 20 to 30% in the US. And you would say that the current valuations definitely aren't supported by current earnings. But obviously, the stock market looks forward. And so we're sort of discounting this year, and we're looking at what's going to happen next year and the year after. And it seems that if we can get a vaccine and we can get people back to work, there's a good argument for the fact that a lot of the earnings can recover. And so the market is pricing that in. The market is also that discounting by the super low interest rates that we have. And the Fed has come out and said, we are going to have zero interest rates for as long as it needs. They've weakened their view on inflation protection so that they can leave rates lower even as we start to see inflation tick up. And so I think because of those factors, the market valuations are justified in the sense that if you look at the earnings in the future divided by the discount factor that's super low, you actually can justify the market valuations. What would be interesting is if we started to see inflation, significant inflation, because of the stimulus money and the amount of money that's in the system, the huge money supply growth. At the moment, that the actual velocity of the money hasn't increased because people are saving all of the stimulus money, which is good because it means that they've saved for the future, which we've needed. But if inflation picks up, then interest rates will probably pick up, which will actually mean the discount factor goes up as well. And the whole market valuation will come into question, at least for a little while, until the earnings can price in with the inflation and sort of inflate themselves as well. The specific question you asked on the tech stocks, it's been really interesting to look at the performance of the whole market. So the small cap index is still well below pre-COVID levels. Value indexes are still well below pre-COVID levels. We've seen a huge outperformance of growth. We've seen an outperformance of large, especially mega cap. We've seen an outperformance of the companies in the space that really benefits from working from home. And so what I think the market is pricing in is a lot of what we're dealing with right now. Doing a conference on Zoom is a classic example of, if this works really well, we might do conferences this way forever. And so maybe Zoom is actually a company that its time was perfectly timed for what's happening, but its time has come and it will actually have persistent revenues even when we have a vaccine. So I think it's difficult to know. The job of the stock market is to try and price these things in, but potentially we've all started to adopt, we've realized that getting home delivery of groceries isn't so bad and it saves us a couple hours every week. We've realized that doing conferences on Zoom is fine. We've realized that having Netflix to stream movies works great. And so a lot of the companies that are what you would call potentially expensive just based on their historic prices in that tech space are actually really well positioned for the work from home adjustments that we're making right now. And the market is pricing in the fact that we might have some more permanence to this. I know a lot of people in the US are talking about, basically we won't be in the office 5 days a week going forward because we've all been pretty productive working from home. And so we should be more accepting of people wanting to work from home for whatever reason. We can network, we can do meetings. And so I think the long answer to your question, but there are reasons to say it's not that stretched. And there's reasons to think, this could be like Apple 15 years ago. It looked like it had a good run, but look where it is now. The change in spending behavior and consumer behavior could support all the valuations. And that's what the market's trying to work out.
I could not agree more with you in regards to that. And you mentioned something important that leads me to the second question, which is the vaccine. Since it's going to take longer than at first initially it was said that we were going to have a vaccine by the end of the year, which was not necessarily realistic. Do you think the market liquidity is shrinking due to that not having that vaccine when we were expected to have it and having prolonged the pandemic? And you see that other countries are going back to lockdowns. some temporarily, obviously, and some partially, but some very strict. I was watching the news this morning, and Ireland is going to a 6-week lockdown. That's very important. What's your take on the market liquidity in that regards? And I'll just like to add something that's coming up very soon, which is the US elections. So what do you think the mix of both of that will take on the market?
Yeah, so that was where I was going to start my answer as well. I mean, the reality is in the US, liquidity is actually elevated. We're still seeing 9 billion share days with not much news on the vaccine, not much new news on, the underlying COVID economy. And so I would put that, and I look at the VIX prices, I look at the prices of options in especially November and December, pricing in a huge amount of election risk, just uncertainty generally. I know that the betting markets are starting to favor Biden pretty strongly, but you've kind of got used to in America expecting the unexpected. And so I think the market is pricing in the chance that we have a prolonged period where we don't really know the result and there's a lot more uncertainty. And so actually liquidity, probably because of the election, is still elevated. But I think you're right. In terms of the vaccine versus the lockdown debate that's happening right now, there is a couple of studies that were put on hold last week, which is not great, but it seems to be not a dramatic problem. There's one vaccine that came out this week and said December is when they're expecting to ask for approval. So I think this end of Q4 period is when we'll start to see some of the approvals at least be requested. The trouble that you kind of highlight though is then all of the doses that have been getting produced go first to emergency workers and sort of to specific elements of the economy, not to all of us. And even in America, there's 300 and something million Americans. Maybe we need 2 doses. That's 600 million doses that need to be produced. Usually it takes a few weeks for the doses to work. So you've got this problem of production and distribution delay in the middle of winter happening, and actually a pretty material spike in cases. And as you said, especially in Europe, the rate of increase in cases is dramatic. There's 80,000 cases in Europe yesterday, which is more than America. We had like 60 odd thousand. So Europe has a big problem. It has that exponential curve again. It's getting to the point where hospitalizations could become a capacity concern. And that's when you see more deaths. So there's a lot of reasons to lock the economies back down. And unfortunately, that's happening before we get, to your point, to having a vaccine available. But I think if we look out 6 or 12 months, a lot of the developed world will probably have vaccines mostly widely available. And that will be really interesting to see whether airline stocks, whether tourism stocks, whether hotel stocks have made it through with enough cash and people can start to basically remodify their behavior back to normal, go on those holidays they want to go on, travel, go to conferences in person. I can't wait. And so I think if we get the vaccine rolling, there was a survey that came out last week, looked at most people's expectations is late Q1, Q2 to have distribution widely. So we've got 6 more months of this, which is not great news for all of us sitting at home, but there seems to be light at the end of the tunnel. So that's going to help, I guess, the valuations of stocks. We've just got to make sure that we don't have this second wave that leads to a whole lot of deaths and economic shutdown, as you said, is pretty dramatic, and it does have a major impact on just the debt levels as well as the GDP levels.
Thank you. I'm gonna make a last question because we have some time limitations here. It's regarding to the Panamanian securities market that were in Panama. It says here, let me just ask the question. Do you think that governments such as the Panamanian one tapping into the markets for pre-funding at the start of the pandemic was an overall good strategy? Panama, we went to international markets. We've been to international markets twice during the pandemic, very early stages of the pandemic and just recently, with very good and successful rates, all times, best times rates for the government. So what is your take in regards to this? Do you think that it was a good strategy being one of the first to go to international markets for funding?
Yeah, I mean, in reality, I think that the response from the G7, from the IMF, from World Bank has just been overwhelming, from the Fed. So normally you would say being first is definitely a good thing, because as everybody realizes the capitulation of liquidity, and it's kind of what we saw in March, isn't it? That the liquidity gets more expensive and the last one in pays the most for the liquidity. But actually, I think the governments globally have just done such a good job of making sure the system is flush with liquidity. I think governments globally have done a good job of making sure that they do provide stimulus, and it's not multiples of annual GDP, but it's a significant fraction of global GDP that most countries have put back into their economy. I think the longer term risk, and it's a risk that every country is going to deal with, is the amount of debt that we're going to run with if we get inflation. So yeah, there's a school of thought that says this debt's okay as long as rates stay as low as they are, because the interest doesn't cost that much. And over time, even if we get a little bit of inflation, over time it'll be quite easy to pay back. The risk is, and I guess especially for foreign countries that are US denominated debt, is you see FX rates change, you see the cost of the debt go up, and that creates more stresses, 5-10 years from now, and we end up with some sovereign debt problems. Which will become a handbrake, like an austerity style handbrake on economies. But in terms of what we needed to do right now, the shutdowns were so dramatic. There was so many people unemployed. There's already a lot of people not paying rent, even in New York. There's a lot of businesses that can't meet rent because they're shuttered, basically because they're forced to be shuttered. And airlines are a classic case where people are kind of doing the right thing by not all jumping on planes, but that's not good for those companies. So I think the government's done the right thing. In the short term, we needed to finance all of this. We needed to go into basically wartime debt levels, which most countries have done. The challenge is going to be getting out of that without rampant inflation or sort of austerity measures. And I think most economists are a bit worried about that, but realize it's a second order concern. Right now, we've got to make sure we don't get bigger problems in the short term from people without jobs.
Bill, thank you so much for your participation in our annual event, the Investors Forum. Thank you, Nasdaq, also for the support that you provide us throughout the years with our investment forum, and have a good day. Thank you. Gracias a todos.